this morning to tell us what he thinks. Nirav, very good morning to you. You know, this week has been, I think, that relief. Almost like you're in the middle of a drought and you get some, relief from rains. This has been the relief that the market has been waiting for.
Yeah, so markets tend to overextend on both the sides. So we obviously overextended a bit on the upside, and when the correction happened, you overextended on the downside, which is nothing unusual. Uh, I would go out and call out that we already seen the bottom. So a lot of the stuff that was holding you back, right? So we ran an unusually tight monetary policy. If you just exclude fruits and vegetables, the core inflation was 3.2%, lowest in about a decade. If you look at the fiscal policy, because of elections, there was an unintended pullback, right? So a lot of the things came in. And the biggest problem, and we've always seen that, post Trump coming back with a very popular vote, you had a 10% rally in long-term bonds and DXY. And you've seen massive outflows of dollars. All the 3 points have changed structurally, which should ideally make you very, very bullish.
Okay, which should ideally make you very, very bullish. What does that translate into for people who are watching? There might be some who are sitting on the sidelines with dry powder, those who are looking at their portfolios and saying, okay, wait, some more semblance of return needs to be seen. Should there be realism in terms of expectations of where this trend will also continue?
So my sense is that if you are sitting on dry powder, you should have ideally been invested, but you can't get the bottom at one particular point of time on a one particular day. And usually when you try and get back into the markets, if at all you are trying to time, then I would like to believe that it's more a bottom-up approach. So let me just come back to what I was trying to highlight. You've seen a decisive change in monetary policy, not only in terms of cutting the rates, but also in terms of being fairly prompt in terms of providing liquidity to the markets. I'm talking about the liquidity at the left window, which is very, very critical to my economic growth outlook. I cannot have my credit growth at 10, 11% and then get bullish on the economy. It doesn't work that way. So that will change. You've seen almost about 6 or 7% pullback in DXY. I'll probably go that into detail later on. But suffice to say, and this is very critical, US, I think, is moving away from a very loose fiscal policy and a tight monetary policy to now a tighter fiscal policy and a loose monetary policy, which is very, very emerging market bullish, which means that you can look at an extended period of a lower DXY and therefore stronger rupee. So that is very bullish for my FI inflows. And obviously, my fiscal spending is starting now. It's not going to come back with the same engine because there is capacity in terms of how much the government can spend. But these three macro factors are aligning. I believe that earnings this quarter should be better than what we've seen in the last quarter. And we should have mid-teen growth in FY26 and beyond. That's very good stuff in terms of, on a relative basis, if you look at even what's happening in the world.
Yeah, morning. And you had this, I believe, 11, 12-day conference in the US or maybe more. Do you sense from global clients that money will come back because we've started to see the first signs of it? We spoke to a couple of FIs in the last 3 days, and they have started nibbling into India. What's your sense?
So I've been trying to stretch my head, Nirav, for some time. You can always argue that the markets are overvalued and therefore, you're bound to lose some of the fast money that comes in and that trades in and out of the market. We've seen an unusual selling over the last 6 months, and it can't be just led by valuations. Also, this correction was largely local, right? So we've seen new highs in Nasdaq, in Dow Jones, in Europe, and a very strong rebound in Hang Seng, obviously of low levels. So there was some sort of dislocation as long as when you look at the FI inflows. I suspect a lot of this has to do with rally in bond deals. That sucks away the dollar liquidity in the world, right? So to me, and we'll see as we move forward, all of us are learning. But I believe that if my hypothesis is right, that US is likely to see lower bond yields going forward. the Trump administration is very vocal about having a weaker dollar because they want to insource manufacturing. Then I think this last 4 or 5 years of big headwind in terms of strong dollar, I think will change. That changes the narrative, and that should lead to a very, very strong inflow of dollars. That's my view right now.
Yeah. I mean, you kind of reiterated. I mean, I can see how strong you believe in that, right? Your view on DXY and the resultant flows for emerging markets as well. Nirav, just what the question only is that we've seen a Europe which is strong, we've seen a China which is strong, both of which were largely weak in 2024, arguably some part of 2023 as well. Does the last dollar which is coming in eastward get split majorly between these two, or do you reckon, in your sense, that India will see significant inflows or sizable inflows as a result of your hypothesis for 2025? Will it be a banner year for inflows, or is it difficult to say?
No, I would like to believe that we should recoup what we have lost over the last 6 months. My starting hypothesis, Neeraj, is that there is a global saving pools, right, that keeps on increasing at 2 or 3%. Let's say my global GDP growth is about 3.5%, which means that my savings keep on increasing at about 3.5%. Now that logically that money should come, India should have its share of that incremental flows. It's like you don't argue that your deposits grow at 9 or 10% every year. You just take it for granted because my savings are increasing at the same proportion. We lost a large part of the share over the last couple of years, and I think that will change. China obviously was battered down, but I still believe that there are structural problems in China. It's a trade market. It is not a structurally investable market. They have got scale at the expense of ROE, right? So you don't have those there are very few tech companies that you would like to own over there. Europe, I think, is seeing fiscal stimulus, which is you can be bullish on Europe. I consider that, and they need that. They're overtly conservative in terms of trying to run very tight fiscal policies at the expense of growth, and maybe because their background is the Hitler era and hyperinflation, so you get psyched by that. It's not very easy to take that off the back, but they're changing because you're forced to change.
Nirav, you're sounding cautiously optimistic, if I may say that. If I ask you to stick your neck out and tell us where you think the Nifty is going to end 2025 with, what would you say? And which set of stocks are going to be the big booster? Is it going to be banking, as everyone's betting on?
We are very bullish on banking, but to answer your question, I don't know if I sounded cautiously optimistic, but I am optimistic, and I won't be surprised if we make a new high this year. I see a brutal correction that happened since September to be a part of the bull market correction. When I look at the relative global map, I don't see any country which is growing at about 6.5%. I'm not even talking about 7% growth rate, which means about 9.5 to 10% growth rate in nominal GDP and about 11-12% earnings growth rate. You die for this kind of growth. And with the rupee, which is very, very stable, look at so many guys who are very, very bearish on rupee, right? Because obviously the big short position that is sitting. But I think we've done a phenomenally good job. Why do you need $700 billion if you can't defend the rupee?
Okay.
So I'm very bullish.
Okay, no, I'm just saying that because I've heard how bullish you can get and it's unfettered. Today you were, hedging, but yeah, what you've ended up with is great. If you're saying you can make new highs, and the last highs for the Nifty being 26,000 upwards, then you're seeing a sharp recovery from here. May not be in one go.
Yes, I think by the time you start looking at FY27, you're in FY26. In 3-4 months, market will start discounting FY27 earnings and lower interest rates, and we'll see new ones.
Oh, wow. So watch out for the next 3 months. That's the word coming in from Nirav Sheth. Thank you so much for speaking with us, Nirav. Always a pleasure. That's all the time we have, though, on India Market Open. And it's been a good morning. Started off a little